All right. Good morning, everybody. So we got our announcement yesterday, and looking at some of the options activity. Looking at on the monthly, had a little bit of put ratio or put activity in there. You got to remember the way the institutions tend to trade, unless they're in the very, very short duration. Uh, they tend to be on the buy side less often than the sell side. So when you see 6 weeks or so, or you see monthly contracts being traded, they're very often sell to open, not buy to open. All right, what do we got on the agenda today? Jobless claims and additional auctions. So the 11 and 11:30 time frame is going to be really important today. It's these kind of additional auctions that become game changers in the afternoon. Uh, a lot of those midday reversals that you see in often come from a situation like that. So pay particular attention today at 11 o'clock. We have no expectation of a lunch window today. And I believe starting this week, maybe starting next week, we're going to be having uh, 5 days a week when it comes to SPY and options. All right, so SPY, SPX. They added Tuesday a few weeks ago. They're going to be adding Thursday, I believe, next week. At which point you will see expirations every single day of the week. We're not seeing them lined up here yet because they're not added yet. So we'll likely see that starting next week. So you'll have 0-day trade opportunities every single day of the week. We still don't know how much that's going to affect the marketplace. They experimented with 3 expirations a week for almost a decade before they branched out and put it onto different products like the Qs and the other indexes. And one of the things that happened because they had 3 expirations a week in the SPX for that long is it became one of the most accurate expected move products that exists in the options world. It's why we focus so much on it. It's why it's benchmarked in everything. It's going to become even more accurate now. So the volume that you've seen when I first started this stream, that was options volume, not stock volume. Unless you have a special indicator to see it, you're not going to be able to see it that way. All right, so what do we got going on? Well, we are sold off nearly 0.75%. It kind of makes sense when you think about linear regression, mean reversion. When you think about how far and how fast the market moved yesterday, and hopefully you guys took my warning to heart and was ready for the trade opportunity. It was very unlikely. It was very unlikely that we were going to just have a little bit of a bump, right? It was going to be a significant move in one direction or another. In the chat yesterday, I took a picture at the end of the day of what that FOMC impact was and compared it to March and what that impact was. You want to get in the habit of looking at how these events unfold, because everything we do in trading comes back to probabilities, right? What's the probability that it'll do A versus B? How likely is it to do A versus B? Historically, what's happened when A or B happens, right? That it's that same logic. That's trading in a nutshell, just running on probabilities. So the more you can recognize what's happened in the past, the more you can understand or anticipate or prepare for what's going to happen next. Speaking of what happened next, when we get a move like this, a significant exaggerated push in one direction, one time framing, individual one sided price action, nobody was going the other way, right? Nobody was taking the other side. No institution or firm or trading group was trying to short this. It was all long. But those banks and institutions and trading firms have been trying to unload some of their biggest trades for a long time. They keep selling the rip. And it makes sense when you think about it. BlackRock, JP Morgan, Wells Fargo, those guys own billions and billions of dollars of Apple, Google, Microsoft, Amazon. And none of them want to just dump it, right? Because that would dump the market. So they take the opportunities to sell into the rips. Some of the biggest bull moves we've ever had in the history of the marketplace has come during bear market conditions. So there's always the expectation that we can have big runs to the upside and dead cat bounce and extreme push. We don't expect it to last, right? Just like the last one, if you're wondering where the last one was, it was March 16. So right there, that was the last Wednesday where we had a Fed announcement. And you can see that in the overnight hours or on the next day, there was a lot of downward price action in that wick. And that move to the downside through that wick extended almost halfway through all of the explosive move that happened during that Fed announcement. Makes perfect sense because it's what we see all the time. When you get a very large candle, you get a very large amount of price action. Price often goes back and validates the move, right? Because it leaves a liquidity vacuum behind. So here we are this morning. Price ran all the way up into its resistance point, all the way up to the roundy. It took a rejection there and it pulled back. Now, we very well could see a few more days of this continued bullish price action. It's what happened last time. But it's not the end of the move, right? We're not going back to all-time highs. We're not out of the woods. Nothing has changed in relation to all of the things that's driving this market down. But there is a little bit of seasonality. When the Fed threatens to raise rates, the market sells off because it starts pricing in those rates. But once they actually do start raising rates, historically speaking, we tend to rise when they do that. So we had his announcement, the market liked it, we had the rise. When they start actually raising the rates, that's going to add to it. We're likely to rise. But there's all the things that's been causing this market to sell off in the first place, which isn't just the idea that they're pricing in the rate hikes. That hasn't been the only reason we've been selling off through all of this. Supply chain, runaway costs, everything comes down to earnings. At the end of the day, when it comes to the indexes, the S&P and the Nasdaq and the Dow and the Russell, it's the companies that make up those indexes and their earnings that continue that growth within the index, that buoyed move to the upside. A lot of the biggest banks right now have said this is very likely going to be the last good quarter for at least a year, maybe a little beyond that. The institutions, these companies, they're going to start coming out and saying, we missed our guidance. We didn't make enough product. We couldn't sell enough product. We couldn't keep enough employees. We lost money because we couldn't do this. We couldn't do that. And it's going to ripple across. So take the moves while you can get it. Get the up moves into the next resistance level, but still be prepared for the idea that we're not done yet. Right? The range has been clearly set all year. This is the start of the year, way over here. So that's the start of the year. This is January across. We're still in the range, right? With every expectation that we're going to either maintain this range or break lower out of it. So take the move while you can get it, but be prepared to sell the rip. For today, what's the expectation? The expectation is that we come down and reset the move, 4,200, and then continue on. Or that we maintain the current Globex low, hold this level below 4,300 till we come into the open and continue the advance to the upside. Really not a lot of choices beyond that. Now we could just stay within our reset zone between 4,200 and 4,300. It's possible. We absolutely could do that. We never want to say we can't do it. But if that's scenario one, if that's our range, then scenario two for a downside breakout would mean that we would actually need to get all the way below yesterday's lowest point. That's focusing on 40, we'll call it 4150 for some easy numbers. So we would need to get below that before we actually would be considered moving to the downside. That's a long ways away. We want to be able to quantify that, right? How far away is that? We've got an ADR right now of 2.2. So from our current location where we are down 6/10, we want to go ahead and add another. Let's just add a 1.4 to this, to the downside. 1.4 would put us down to our starting position yesterday, of the starting position of that breakout, 4,200. Pretty close to it, right? It's not spot on perfect. So that's 2% right there. And go ahead and add another 2/10, and that gets us down to 4,200. It's a good round number to focus on. So if we maintain our ADR, it's 4,200 to the downside. It really kind of lines up with that line we already had. But it's nice to know that our line actually matches something more than just random wicks that we can draw on the chart. For our ADR move to the downside, if we maintain that 21-day ADR with a 2.2% move, that would put us to 4,200-ish. So breaking out of yesterday's low would require an extraordinary amount of price action. It's important to recognize that, right? Like we gotta ask the question, what's normal and what's our expectation today? Are we going to maintain within our normal boundaries, within our normal price action? These ADRs and ATRs and expected moves, think of them very much like a bubble around price, right? And with price being in the middle of that bubble, we can look at the edges and say, well, how far is it expected to move? And that expectation can be on a daily chart, an hourly chart, a minute chart, right? It's a square root of time formula, so you can put it wherever you would want to put it. We're using the daily, which is a 2.2%. From the where price sits, if you go 2.2 in one direction and 2.2 in another direction, that's 4.5% range, right? And you add the two together. A downside move, 4,200, that's as far as we're expected to go if we maintain normal price action. If we get extreme, if we start to see bad news, the market's selling off, increased correlation within the indexes, we could expand beyond the ADR. And it still doesn't get us to yesterday's low. So we would need even more than that, right? It would have to be very extreme selling to get us down to yesterday's low. So having an inside day breakout to the downside, I don't want to say it can't happen, but that's the least likely scenario out of all of them. More likely, we'll maintain this zone, or we'll begin working our way to the upside. For that to happen, We're going to need to get through yesterday's high, which is still untouched. We haven't even come into contact with it yet. That would be at 43.03. And then beyond that, we would want to look left and see if there's anything that we're likely to hit. And when we look left, we really want to take it out to something like the volume profile, have an idea of something more than just, oh, I see a pivot point back there. So from that perspective, if we were to look left and ask what's out there to hit, there is a lot of volume in the volume profile at 43, call it 4380 area, right underneath that 4400. So in a move to the upside, we're very likely going to make contact or have some kind of interaction with that 4380 area. We were outside of the box. We're not now. We came back inside the volume profile. It's worth noting, look how narrow that volume profile is. And the bulk of all of the volume over the last 10 days is centered right down into that very narrow area. That's how much trading activity happened in these last few days, and the greatest amount of volume. Zoom in here just a little bit. It's the 4211, 4212 area. That's where the greatest amount of volume was. You can't claim that Monday and Tuesday provided that volume because we didn't hit those levels Monday and Tuesday. It's only in this area where that volume happened, right? Because that's the only time that price was in that area in the last 10 days. So that was the greatest amount of volume right there. Having said that, though, within the last few days, we did make a run towards it, and we started to collect some very real volume around these areas. I think given one more day, it would have moved that point of control down to the 4175 area if it was given just a little more time. That is a substantial amount of volume. But we're out of it. We're over it. We're also above the anchored VWAP. The expectation when we're on the edge of the box is that we stay in the box and we begin working our way back down. That's the way a normal box and a normal volume profile would work. When we are at the low, we expect to go to the high. When we're at the high, we expect to go to the low. There's always unusual times where we don't do what's expected. When we break out of the box and continue to drive farther away from the box. But the really easy thing about that, or the good thing about it, is that it stands out, that we are doing something unusual. We left the box, check, that's unusual. We are continuing to drive farther away from the box, check, that's unusual. It takes a substantive amount of volume or trading to continue to push us farther away. So it's worth noting. And it's easy to spot, it's easy to keep track of. We do now have an untouched point of control at 4180-ish. It's unlikely that we're going to resolve that anytime soon, unless we do make that move back down today or tomorrow. And we still have an untouched point of control at around 4100. 4118, 4111-ish. So if we were to retrace it or give back half of yesterday's move, that will put us right around 4220. If we break out of yesterday's price action and have an inside day breakout, 50% of yesterday's move to the upside would be 43.85. That's a nice target in theory, but we still got to be able to ask, is it within our boundaries of what we could hit? Well, we're down 0.6. So if we go to 0 and then add 1%, that would be 1.6. Add another 1%, that'd be 2.6. And that gets us at 43.81, so very close. That would still leave 2/10 on the table that we could move, and it still wouldn't be considered too far. So 50% of yesterday's move is within our range. We're not asking too much out of the market to make a move that far, and it wouldn't be considered extreme. So now we have a strong starting point for what's our expectations for the day. Really keep your eye on the financials today. I think they're going to have a significant impact into our trading day, starting with what we've already seen unfolding here. You see the dollar trying to reclaim some of that move from yesterday. I don't know what to make of this morning with the dollar. We're bidding back up, but we're not seeing its impact in the market. We're not seeing much anything out of the bonds either. The VIX responded yesterday to the fall, but the VIX has been worthless in the last few weeks. It was a shock to see it selling off as much as it did when it hadn't been responding to any of the moves that we would expect it to make to the upside. When our markets were falling in the S&P and the Nasdaq, we were getting fall in the stock market and not a rise in the VIX. And yet yesterday during the rally, we did get our fall in the VIX. So it seems to only be responding in one direction. It's another thing that makes me look at it right now and say, I don't trust the VIX to give me any perspective or any insight on fear and greed and risk on, risk off sentiment. I'm going to continue to focus on the dollar and pair that move in the dollar with the VIX and measure it against the bonds. All right, for the Nasdaq, we're down 0.75%. We made a substantive move yesterday. When a market makes that big of a move, very, very often it goes back and retraces the starting point, right? And the starting point would be right around the time he started chipping his teeth. So 13.1, maybe 13.15. At the very least, I would expect 50% of yesterday's range to be retraced. If we are slightly bearish, that wouldn't be an aggressive bearish move. That would just be kind of slightly bearish. Really good way to look at it. Retracing 50% of yesterday's move would put us right around that 13,200 area. And it's well within our boundaries of the expected move. We're not reaching at all to hit those targets. That's 1.5 from our current location. So that would be 2.25. We've got an ADR right now of over 3. So easily able to hit that. I find it very unlikely that we're going to have an inside day breakout to the downside. Just getting to that location would be a 4% move from our current location. So you're talking about 4.75% down on the day just to get down to yesterday's low. It could happen. I just don't think so, right? We never want to say it can't happen. It's improbable, not impossible. So why does it matter, and why do I keep pointing out the daily level? Think about the way we perform technical analysis, and we look at the candle sequence. When you have higher highs and higher lows, or lower highs and lower lows, right now we're talking about an inside day, focusing on yesterday's price action. What we're also talking about is the idea that we won't get a lower low today. It's very unlikely that we're going to get a lower low, because it's very unlikely that we're going to break outside of yesterday's price action to the downside. Take that off the table today. For my failed flag that I use, this is a primed setup. We'd be looking at the channel, be getting a little bit of a Busby, and then a continuation in the breakout, right? So the range, the breakout of the range, the Busby, follow through, which kind of fits anyways, because we're still expecting some of that retrace first before we do anything else. (8:30, 10:30, 11, and 11:30). That's basically the entire morning. Throughout the day, almost every hour on the hour, all morning long, there's going to be econ. It's very likely going to disagree with itself, right? Some of it's going to be positive, some's going to be negative. There may be some muddy waters where the numbers don't really tell anybody anything, and they got to call the nerds and wait for the nerds to give them some guidance. So we may see some choppy price action, a retest of the lows. We could wick down lower than our current lows, but pay attention to the difference between wicking down through a current low and closing below a current low and making a continuation in that direction. Looking at the volume profile, it's the same situation. We've got a very narrow box. This is a condensed value area that all of the volume, or 70% of all of the volume, is right there within that zone. And the greatest amount of volume is right at the point of control. That would be 13,100-ish. Just keep in mind and keep reminding yourselves nothing's changed, right? Nothing's changed. They did what they said they were going to do. The market had already priced in what they said they were going to do. They gave us their forward guidance on how aggressive they're going to get on the balance sheet. And all the other troubles and all the other situations are still there. And the funny thing is, throughout history, every time we've ever had a market that just took a serious and absolute crash, it wasn't because of something we knew, right? Go back and look at COVID. We didn't see COVID coming. Or go back and look at the '08 housing crisis, right, with Lehman Brothers and all those. Sure, by the end, we started to see it coming, but by then it was too late, right? They couldn't do anything about it. Or 2018 in October when we took that massive sell off. Every one of those events were ones that we couldn't see coming. Every one of those different Black Fridays that happened throughout history. It wasn't any of the things that they talk about on TV every day. It was the one that caught us unaware. So all the things that they continue to talk about right now, the war in Russia, the supply chain issues, the earnings, the lack of people, all of those issues are the known things. It's going to be something that we don't know that catches us. All right, minerals are up, gold, oil. Got a lot of markets that are flat and everything else is down. Now, just like I normally talk about, when we're up or when we're down in the pre-market, my benchmark is around 0.5%. So for all of these markets that are down, but it's only 0.25% or 0.3, that's not enough for me to consider it down or not down. We want to carry that expectation that yesterday had a very explosive move and that its natural instinct is to drift back afterwards, right? So these being down some or slightly, it makes perfect sense. It's not in any way reflecting a bearish market. You You shouldn't be bearish this morning coming into the market. And while it can get bearish, you shouldn't be just instantly maintaining some bearish bias, right? Look for the market to give us some signals that it wants to actually be a negative market, right? We're not in a risk off or a risk on situation yet. I think a lot of us are still sitting in that hold up, well, let's see what's going on situation. Looking at the sectors, we're not going to get a lot of perspective out of any of these sectors because just about everything made that move yesterday. So just about everything this morning is going to be pulling back after that move, right? So all of these negative signals, they're not telling us anything. Now, the ones that are down a significant amount, emerging markets, we use this for risk on, risk off perspective around the world. This is our global gauge of risk. It's down way more than that negligible amount, right? It's more like 1.5% to the downside. So that's a very bearish signal this morning. That's something that we can grab a hold of. Or semiconductors down 1.25%. That's legit, straight up bearish in the semiconductors. But a lot of these 0.25% or 0.3%, that's not enough to be bearish. So one thing you can do this morning is start to focus on what names are up today. There's a significant amount. You can see we got to scroll quite a ways before we start to get out of the 1 and the 2% moves. Twitter has news, so it's up, but things like Trip, GLD, Expedia, Kinder Morgan, Monster Beverage. So there are names that are up. There are opportunities out there. So the idea this morning would be to track those names for your opportunity. I'm going to be looking at anything that's moved extreme. I want to focus on anything that didn't make that really big move yesterday or didn't make very much of that move. So I'm going to be focused on anything that was running contrary yesterday. I think that'd be a good way to approach the morning. And then other than that, just looking for these numbers to come through, the jobless claims, and then the auctions. So for me, I think the afternoon is going to provide way more opportunity than this morning. Keep in mind this morning, since we have a econ almost every hour on the hour, uh, take your profits. Don't expect whatever we get at the open to stick through the rest of the morning. Be prepared for those reversals. All right, everybody, that's what I got. Be careful, be safe, have a good morning.